Welcome to the deep dive. We take the reading list, the reports, the data you need to understand, and, well, we distill it for you. Think of it as your shortcut to getting up to speed.
Fast.
Exactly. Today, we're digging into a financial insights report from Pridia Capital. It's dated Thursday, May 22nd, 2025, Eastern Time.
And it covers quite a bit. Market performance, sure, but also those geopolitical undercurrents, bond yields, the whole picture, really.
Right. Our goal here is to give you a clear handle on the forces shaping things right now. Maybe connect some dots you hadn't seen.
And hopefully without the usual information overload.
Yeah, hopefully. What really grabbed us first in this report was this kind of tension, this juxtaposition. You've got real optimism still in the tech sector,
Mm-hmm.
butting up against some pretty serious caution everywhere else because of, well, global uncertainties. Let's
Yeah.
let's unpack that a bit.
It's fascinating how Pretty Capital frames that exact point. They note that even with all this instability simmering globally, the actual metrics for venture capital funding,
Yeah.
in certain AI-driven areas, they actually went up leading into May 22nd.
Oh, interesting. So it's targeted.
Very targeted. It suggests investors see, specific, maybe future-proof potential there, almost flying in the face of the broader worries.
Okay, so not just a vague tech is hot feeling, it's specific pockets attracting real money, despite everything else.
Exactly.
Now, this other side of the global uncertainty, the report says it's hitting commodities, currencies. What kind of uncertainties are we actually talking about here? How does that, show up?
Well, the report doesn't list every single event, but it talks about the cumulative impact. Ongoing trade tensions, for example, they're cited as adding to volatility in commodity prices.
Like energy.
Metal, energy, yeah, and rare earth minerals
Yeah.
specifically mentioned. And that pressure then spills over into certain currencies. So especially emerging market currencies seem more vulnerable to these shifts. Pretty Capitals actually uses the term fractured globalization.
Fractured globalization. That paints a picture. So, this laser beam optimism in parts of tech,
Right.
but broader unease making waves in traditional markets. And the result, the report says, is this mixed momentum in the big indices. It's
Yeah.
not just straight up or straight down.
Precisely. And you can't really separate them, can you?
Yeah.
The report stresses how linked it all is. Concerns about supply chains maybe stemming from that geopolitical instability
Uh-huh.
that can dampen the mood even for sectors that look optimistic on the surface if they rely on those global connections.
Which brings us neatly to the actual market performance snapshot for May 22nd. And in the
Right.
US, I mean, it was pretty red across the board.
Quite negative.
S&P 500 down 1.61%, Nasdaq off 1.41%. The Dow took an even bigger hit, minus 1.91%.
And the Russell 2000.
Oof, yeah, the Russell 2000, the smaller companies index, really felt it, down 2.80%. That's more than just a little dip.
Absolutely. And Preta Capital's analysis, well, it suggests the link between that steeper Russell decline and maybe worries about domestic economic growth, in the face of all the global stuff. Smaller firms often feel those local shifts more.
Right, makes sense.
What's also telling, I think, is the VIX index jump. It popped up over 15%.
The fear gauge.
Exactly. And the report explicitly links that spike to more trading in put options.
Right.
Basically, more investors hedging their bets, protecting against potential further drops.
So yeah, paints a picture of real anxiety in the US markets that day. But then it's kind of striking when you look across the Atlantic, Europe, different story.
Totally different.
The FTSE 100 in London actually nudged up just 0.06%, but still. And Germany's DAX, a more solid gain, plus 0.36%. Why were they holding up better?
Pretty Capital floats a couple of ideas. One, maybe European markets just had less direct exposure to whatever specific sectors were dragging the U.S. down that day. And second, they mentioned potentially more stable economic data coming out of the Eurozone just before the 22nd. That might have offered a bit of a cushion, some reassurance.
So local factors still matter, even with global headwinds.
Definitely highlights that.
And then Asia adds another layer again. Japan's Nikkei down 0.84%. Hong Kong's Hang Seng fell 1.13%. Cautious.
Cautious.
But then Shanghai in China, a much smaller dip, only minus 0.18%. That relative calm in China seems interesting given everything else. Any insight there from the report?
Yeah, just touch on that. Pre-D capital suggests maybe a mix of things.
Right.
Ongoing government stimulus efforts within China helping, perhaps.
Right.
And maybe a degree of insulation from some of the specific tensions hitting other places. They also mentioned a continued focus on domestic consumption in China, which might be buffering some external pressures.
So putting it all together, it's really a mosaic, isn't it? U.S. leading the downturn, volatility spikes, Europe showing some resilience, maybe surprising strength. And Asia, kind of cautious, but nuanced, especially with China. Regional differences are key.
Absolutely critical to understanding the full picture.
Okay, let's pivot now to the bond market. Because the moves there often give you, well, maybe a deeper read on what investors are really thinking about the economy, about risk.
For sure. It's often where the subtler signals appear.
And the report highlights some pretty big shifts in Treasury yields. The 10-year Treasury note yield, it jumped to around 4.60%. That's a 2.57% increase in yield terms. What's the immediate takeaway from that kind of move?
Well, a jump like that in the 10-year often signals a kind of reassessment, maybe of risk, maybe of future growth, maybe inflation.
Okay.
Pre-D Capital points to maybe a couple of things coming together. Some inflation data earlier in the week, perhaps a bit hotter than expected,
Uh-huh.
and maybe some signs that economic growth, while not booming, is still holding up okay. So investors start demanding a higher return, a higher premium for holding that longer-term government debt.
And yields up means prices down,
Right.
right? For the bonds themselves.
Exactly. That inverse relationship is crucial. So holders of those bonds saw the value dip.
Okay, but then kind of counterintuitively, the very short-term yield, the 13-week T-bill, that actually dipped slightly, down 0.31%. How does that fit?
Yeah, that can seem odd at first glance, but that little dip in the short end, it often reflects a flight to quality when things feel uncertain elsewhere.
Safety seeking.
Exactly. Even as longer yields are rising because of inflation or growth expectations, some money might be rushing into the safety and the easy access, the liquidity of very short-term government debt,
Yeah,
like parking cash while the storm passes.
okay.
Pretty Capital's report actually mentions increased activity in money market funds around this time, which kind of fits that picture, a temporary safe haven.
Right. And then the really long end, the 30-year Treasury bond yield, also up significantly. It hit 5.09%, a rise of 2.48%. What's the signal from way out there on the curve?
The 30-year is often seen as reflecting really long-term expectations, especially about inflation.
So investors thinking inflation might stick around.
That's a major interpretation. If the market thinks inflationary pressures are going to be persistent, way out into the future, they'll demand a higher yield now to compensate for that loss of purchasing power over decades.
Makes sense.
Predi Capital also suggests, maybe with a bit less certainty, that expectations about future government borrowing needs could also be playing a role in pushing that long yield up.
Okay, so let's piece these bond moves together. You've got the 10-year and 30-year yields climbing, suggesting inflation worries, maybe some growth.
Right, demanding higher returns for the long haul.
But the very short-term yield dipping slightly, hinting at some immediate caution, that flight to safety.
Exactly.
What's the overall story the bond market seems to be telling us on this particular day?
It seems to be telling a complex story, really, not a simple one. The higher long yields point towards those persistent inflation concerns, potentially higher borrowing costs down the road for everyone.
Mortgages, company loans.
All that stuff, yeah. But that little dip at the short end, combined with the equity market jitters and the VIX spike,
Mhm.
it shows there's still this underlying anxiety, this caution bubbling up.
So inflation and nervousness.
Preda Capital sums it up as a market kind of wrestling with both, grappling with inflationary pressures on one hand
Hmm.
and these economic anxieties, maybe geopolitical ones too, on the other. It's a tricky balance.
Okay, so to wrap this all up then, on May 22nd, 2025, looking through this pretty capital lens, the financial world presented this, well, really fascinatingly complex picture.
Technically complex.
You had that pocket of real strength, that optimism in certain tech areas,
So hold on.
but it was clearly fighting against this much broader backdrop of global unease, global anxiety. And you saw that tension play out, didn't you, in how different markets performed around the world, the US down, Europe holding up better, Asia mixed,
Right, that divergence.
and in those really interesting sort of contradictory signals coming out of the bond market.
Exactly. This deep dive really just hammers home that you can't just look at the headline number for, say, the S&P 500. You need the nuances,
Yeah.
the regional splits, what the bond market's whispering. It all builds a much richer and, frankly, more useful understanding of what's actually driving things.
Which is exactly what we try to do here on the deep dive, provide that richer picture.
Oh, so.
So, as you, her listener, are processing all this, here's maybe a final thought to chew on. We saw these diverging performances today, right? Different asset classes, different parts of the world moving differently.
Yeah, quite starkly in places.
Could that be a sign of something bigger? Are we maybe entering a period where markets become less synchronized, more divergent going forward? Are those old correlations starting to break down a bit?
Interesting question.
And if so, what new questions does that raise for how you need to think about the global economy, about your own strategies in the months and years ahead?
Definitely something to mull over.